To build a multi-property portfolio, you're definitely going to need to know a few tips and tricks. And in this video, I want to show you how you can use one deposit to go and buy multiple properties. There's also a difference between doing it the simple way and then the advanced way. So if you watch all the way through, you'll definitely get the insights of exactly how I would do it if I had to do it today. If you're interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now in a second here, I'm going to share with you my whiteboard and I'm going to show you what most people are doing. I'm going to show you the simple way to do this. So you may just walk away and go, hey, simple's good enough for me. So if you're here to see how you can do it the quickest way and actually build a portfolio in the next 5 to 6 years, then definitely watch all the way through. All right, so what we're seeing is one deposit actually turning into multiple deposits for multiple properties. And I'm going to show you the simple way and the advanced way. But to start, I want to show you what most people have been taught to do. I got taught the exact same thing when I started, and I'm so glad I spoke to the right people, listened to the right things, and then was able to actually learn from there. Hopefully you're watching this video and going, yeah, this is probably the right person to listen to. So with that, let's continue. So how exactly are we doing this? So the simple way we've been all taught is save a 20% deposit, and you're going to do that in cash, and then you're going to get an 80% LVR, so a loan to value ratio. So 80% will be the mortgage, and you've got yourself a house, right? So pretty simple stuff. And you'll notice now as well that if you look at mainstream media, they now often refer to how long do you have to save for a deposit in Sydney, Melbourne, Perth, whatever. And that number keeps increasing every year. Despite interest rates going up, despite the fact that prices have gone up or down, that number still continues to go higher. Now what they're starting to refer to is not how long it would take as a single person, because those numbers are ridiculous. It's like 10 years plus. It's how long does it take as a couple. Now, if you're not in a couple, not only do you feel bad, but now the mainstream's making you feel bad as well because you can't get ahead financially. So let me show you a way that you can do it by yourself. So if you're single and you're happy, then you can do that. And if there's two of you, well, you do this twice as quick. Then you've got how the rich people are doing it. Now what they're doing is instead of saving a 20% deposit, they're saving a 10% deposit. They then pay a thing called LMI, lender's mortgage insurance. So many people are scared about this. They're like, why would I pay more money when I could just save a 20% deposit? It's because saving that last 10% deposit could mean you're out of the market for another 12 months. Now, if you're purchasing a property for 500K or 700K, you could probably save that in a year. But chances are, if you're trying to buy a place for like $1 million plus, that's going to take you a couple of years. So when you're thinking about just 10% extra, it could mean 24 to 36 months out of the market. Now think about that $1 million property. It's probably worth now 1.2. And so you always feel like you're falling further behind. So by going in with a 10% deposit, you're getting into the market quicker. You then take up a 90% mortgage, and yes, you've got the same house. So this happens on your first property. It's harder to save every single time. That's why you'll see that even for myself, how do I get to so many properties in such a short amount of time in my 20s, which is traditionally not when you're making the most money. It's because when you know the rules of the game, you're able to then optimize that system to be able to go and invest the right way. And so here we've got an example. Person goes out to buy a 700K home. You save a 20% deposit, which is about 140,000 plus costs. So that total is about 160K. That then converts it to one property. So $160,000 buys you one property. Now, what you'll have to do is go, I'm going to have to save another $160,000 to buy my second property. Now, imagine this. It takes you 7 years to save the 160K, right? So you started when you're 21, you get to 28, and you finally got the deposit to purchase the first property. Now you're like, shit, I gotta do it all again. That is incorrect. And that's why I put you wrong with a big cross there. And I'm gonna show you a better way to do that. So if you look at a 700K home and you put a 10% deposit down, with your costs, you're only actually putting in $110,000. Now, 2 years later, if you've bought, a reasonably good area, you're getting 15% growth over 2 years. So about 7.5% every year. That 700K multiplied by 15% is $105,000. Now at 80%, right? You could go and extract that equity. So what we're doing here is we're getting the 105,000, you're multiplying this number by 80%, and that is how much a bank is willing to give you. In fact, they're likely to give you up to 90%, but we're gonna cover that in a second. So you go, okay, I'm gonna take some equity out of this property, which works out to be $84,000, plus some savings, and that gets me my second property. So straight away we can see from the original example, which is I want 20% as cash, I can go and buy one property, but to buy my second property, I've got to wait another 6 years or 7 years just to save up that cash to buy the second one. In this example, we've shown you don't have to. You can actually use the equity only 2 years later. So we've gone from 6 years to 2 years, and this would allow you to purchase that second property. Now in this example, your first property is now worth $805,000. Your second property you bought was for 700K. The first property could be either your principal place of residence, in which case you'll earn no rent, or it could be an investment property, and that property will yield you about $600 per week. Now the second one is an investment property as well, and your rent is about $550 per week. So collectively, you're making $1,150 per week. The total value is $1.55 million, and your yield is 3.85%. Yay, whoop-de-doo, we have just cracked the code. And the reason I make fun of that is because so many people will get themselves into this position,
aka my uncle,
and he'll go,
I know how to do this shit, and I'm gonna teach you, Ravi. You run a YouTube channel, I'm better than you.
Anyways, he didn't say that last part, but that's what I think he's thinking. Now, what we want to do is we want to optimize this. But what we want to do, and the reason you're here, is because you want to see the optimized way. You want to see how you can go and unlock actual financial freedom earlier in your 30s, in your 40s, and in your 50s. So I'm going to show you that as soon as you smash that like button. Yeah. Now, didn't that feel good? Felt good for me. It gives me a little tickle. All right, so what's the advanced strategy? The advanced strategy is, instead of buying a 700K property in your backyard, I'm gonna go and outsource this and go and find a property for 500K. I wanna find a suitable property that's gonna have long-term growth, has great cash flow, but I also want something that is fundamentally is good in quality as well. So I'm still gonna stick to a house. So I go in and say, spend 500K in a good emerging area, and that 500K property, I need $85,000 to purchase. So I've got my costs, my 10% deposit, and that means I've got a 90% LVR loan. That means I've got my same property, except this time, after just 1 year, you're recording 12% capital growth. In the first example I showed you, it was 15% capital growth over 2 years, right? Which is pretty average. In my example, what I'm showing you here is 12% growth, and how I came up with this number was because our buyer's agency, Search Property, delivered 12.12% on average in capital gains over 2022. So in 2022, as you probably know, the markets actually came down by between 5 and 7%. Instead, all of our properties averaged out to go up by 12%. That's a shameless plug because I think you need it. And if you don't know what it's all about, definitely go check out this video as to how the whole process works. Am I confident to go and get 10 to 12%? Yes, because we're looking at the fundamentals. Backed by our research, we're able to go and find the right properties. But the main point here is not just about the buyer's agency. It's about what the difference actually looks like. People get caught up in the upfront costs. They're like, I don't want to purchase a house because it costs so much. I might purchase a unit because it's a lower barrier to entry, or instead of buying property, I'll go buy shares, or things like that. It's because we only think in the short term. It's not our fault. It's just how society has designed everything instant gratification. What we can do now is say, okay, I can go and do this the optimized way. And that would mean 12% growth in the first year. So I'm going to be getting $60,000 in equity. I can then go out and use savings plus the equity I make to go and purchase my next 500K property. And that is done within 12 months. So in this example, in 12 months, you have one property, which is now worth 560K. You've got a second property, which you've bought for 500K, but you'll notice the difference here in rents. Rent is $650 per week on the first property and $550 per week on the second property. So in this case, the value of our portfolio is $1.06 million in 12 months, and you'll be getting $1,200 worth of rent, which is 5.8%. The total money required in this example was $105,000. And the total time it took to build this portfolio of over $1 million in property is just 12 months. Now, when we compare that to the first example, you're putting in about $110,000 to $120,000 to purchase the first property. And that total time it takes to get from one property to two properties is 24 months. Now, if you go and compare the two, you're like, well, in my first example, the value of the properties is still higher. Yes, the rental yield is lower. Yes, I've got more risk because I've purchased in an area that may not have as much demand, so it's not growing as fast. What do the vacancy rates look like? What do the days on market look like? Don't worry about all that. We're trying to keep it simple. It's trying to get the principles right, because everything else you can outsource. Now, here's where it really comes together. Now, when you look at that advanced strategy and you go, okay, well, I still have more in the first example, you sure do. But after 12 months, which is now 24 months in total, I've now gathered another $127,000 in equity because I've got these two properties. Now I've got two properties at the 12-month mark versus in the first example, I only have one, which means now I can grow even faster in terms of my equity. And here, what I'll do is I'm going to go and buy two more properties after 24 months, each one at 400K. And before you ask where the hell do I find 400K properties, that's what we do. So if you're outsourcing it, you'll have no problems. You don't have to sit late up at night and figure out how stats work, only to get sold some dud property by an agent. You just outsource that. And on each property, we're earning about $440 per week. So where are we at? After 24 months in this example, we have almost $2 million worth of real estate, renting for $2,180 $180 per week, and the rental yield is 5.7%. What I really haven't even factored into this is how quickly the capital growth actually occurs in comparison to the first example and how that compounds over the 30-year period. If you're simply thinking, I don't want to pay an upfront fee for whatever service, or you're going, I want to do this myself, just know this is a long game. So if you're paying to get an extra 1% of capital growth over 30 years, I'm telling you, it's life-changing. And that's why we're looking at what most people do, which is I'm going to go and listen to the traditional people, aka my uncle. Or you can do it the simple way. You've learned a few things, you want to do it yourself, or you have the advanced strategy, which is what the rich people do. I've actually started understanding a lot more of this over the last year or so, where other aspects of my life, not just including property and finance, about outsourcing that stuff. Think about the example of spending a lovely Sunday cleaning your apartment or cleaning your house. Now, could everyone go out there and afford a cleaner? Well, I'm sure if you just cut back on some alcohol or some cigarettes or even some eating out or Uber Eats, you could probably afford it, but it's a matter of priority. And so for me, when I realized that I could outsource those other things that don't bring me happiness or a great return on investment from a monetary perspective, I can now optimize my process. So it's not just about outsourcing when it comes to finance or buying property, it's about everything in life. If you can go and optimize and really focus on things that you enjoy, you're gonna get a far better return on investment, whether that's through happiness or whether that's through success, return on investment on your cash on cash. If you have enjoyed this video, definitely smash that like button. If you like videos like this, you should definitely subscribe. I bring about 2 or 3 videos every single week. But thank you so much for watching, and I'll catch you guys in the next one. Thanks, guys.